Absolutely, Gary. Gary says, I'm wanting to get acquainted with selling short-term options, okay, against some 2-year leaps I've purchased. I have always tried to stay one standard deviation away from the stock price, but the impression that some traders stay very close to the stock price and roll out when necessary. What are your comments about this? Fantastic. First, in general, what Gary is talking about is a form of a calendar spread or diagonal spread. He's doing it slightly after the fact, and there's absolutely nothing wrong with that. He already owns the leap calls. Let me just add in, let me take out bull call debit. We'll add in calendar calls. Okay, so I just wanted to go here, Gary, for the audience so we can take a look at this. So diagonal spread is similar to the covered calls that we were just looking at, and many gurus and educators and investors trying to sell products on this strategy will refer to this as the poor man's covered call. I am not a fan of that, and many of you have heard me say why. I don't like that term because it sort of dumbs down the complexities of a calendar spread, poor man's covered call. Why is it called a poor man's covered call? Because instead of buying Tesla at $474 per share, and getting that nice $30 or $35 premium for that 500 strike on the covered call position, what if at the same time I had bought a 7 to 8 month out 400 strike call for only $150 and still sold that near-ish term, March or 30-day out 35 call? Now I'm only investing $115 per share instead of $437. It's a leveraged position. And you see these cool little curves with it. So I'm only paying about a third or a fourth to get into the calendar spread, the diagonal calendar spread, using leverage, but leverage works both ways. See, if Tesla drops 10%, $47. From when Don got in the position, he kept 35, so he's only down $12, right? He lowered his cost basis down, so he's only looking at maybe a 2 or 3% loss in this position. In the diagonal spread, leverage works both ways. If Tesla fell 47 points after I got into this and dropped down to 400, where my strike on my call is, this premium might have been sliced in half to only 75 or less. Now you're down 50% on your position, where the covered call is only losing 2 or 3%. That's why I don't like the term poor man's covered call, because it gives the impression that you can just do the covered call for cheaper and you're safe, and you're not, because when you see a 10% decline on the stock, you might be down 50% on your position. And that's the trade-off of the lie of leverage. In any case, what we're talking about here for Gary is that he already owns these leaps on these positions that he was bullish on. He might even have some unrealized profit in those leaps. But what he wants to do on those long calls now is evaluate selling shorter-term premium. And against 2-year leaps, actually, he said, and he wants to stay one standard deviation away. But some stay very close to the stock price. And yes, the reason why most stay close to the stock price in this scenario is the game of time premium. Quick little thing. We look at any option chain for any expiration, 2 years out in time, 2 days out in time, 2 months out in time, we have what we call the ATM bell curve. What the ATM bell curve shows us is the highest time value of any option is right at the money. Not the highest premium, the highest time value. And the calendar spread is a game of time. You want this option to have slower time decay, and you want to collect fast time decay in the near term. So that's why you're looking at closer to at the money in most cases. Get the better time premium. It's a game of time. Out of the money and in the money, you have lower time value, but of course the in the money in the case of the calls, you have a higher premium, but most of that is intrinsic. We're not even looking at that on this diagonal spread. We're looking in this direction. All right. Now, so there's also another thought on this. Okay, I'm sorry. I was just reading a comment here. The other thought on this is that what do you mean by short term? Okay. Oh yeah, Maurice says all of this is done before the first expiration date regarding the rolling. Yes, Maurice, sorry about that. Absolutely. So you might not wait to expiration. You'll do it when your triggers are hit. Okay, and we'll get on that later. Let's get back to the diagonals, which we'll have some, Gary's diagonals here, we'll have some other discussion with that too. Again, long story short, Gary, sorry about that. What I was referring to is, what is your definition of short term? For example, let's just go to the custom spread. This might not be your position, but let's say you are. I would stick with DPZ. And I don't think I have a two. Oh, I do. So let's go 700 days on DPZ. And let's say at some point I bought a 320 call for about $50. So I've got some unrealized profit in this call position. Whether it was out of the money when I started, whether I bought it earlier, it doesn't matter. So here's my long call that's 2 years out in time. Okay. Now this is where I'm going to get to Sam's comments. No, I'm going to do this first, Sam, and then I'm going to get to your comments regarding this as well. Okay? All right. So I want to sell a call now. I want to get some premium, reward myself because the stock moved up as I expected. Now, short term, that's the Sam comment on this. He means, wait, weekly or biweekly? And that's what I want to know by short term. You've got so much time that you probably want to stick with maybe 30-day out options here for a better premium. Why do I say that? Because if you try to go week by week and you have a ton of weeks, 100 weeks to that 2-year out leap, right? It's 700 days out in time. If you sell premium every 7 days, you've got 100 weeks of selling. Fantastic. So we go to the options. We look at our at-the-money calls. These are actually much better than I assumed, but they're at 380. But think about this. This is a $4 premium, which looks rich on a 380 strike. You're looking at about a 1% premium. This is about a 0.5% premium. Okay, a little bit more, 1.4%, 1.5. That's good, because normally when you look 7 days out with the at or out of the money, you're looking at 0.7%, 0.5%. This is close to 1%. Pretty much is about a 1% gain. But it's at 380. The stock's at 371. I could sell the 400, but I'm only going to get 60 or 70 cents. If I go higher, and by the way, I think your one standard deviation for this right now is up here. And you're talking 35 cents, 10 cents, 20 cents in that range. So that's why, although you want to say one standard deviation away, what you're looking at here is the premiums you want are 5, 10 points out of the money, not one standard deviation on this $400 stock. So that was what Sam comments is the reason why people are going at the money if they're trying to do week by week is that you have to get a decent premium. Otherwise, you're getting nothing, and it's not worth it. So how do you say one standard deviation away and get good premium? You got to go 20, 30 days out in time. Still not bad. It gives you about 20 what we call write cycles, how many times you can write the calls based on the expiration time frame of that. And still, though, here you're looking at 120, 240, again, 0.7, 0.8% for the one standard deviation away. The at the money, 750, roughly 2%, maybe a little bit more if we consider midpoint. Okay? So, is there anything wrong with doing one over the other? Let's go back to our previous conversation we just had. Like the covered call. Now, I'm not saying people are wrong to use the term. They're using it as a sales term to say the poor man's covered call. Remember, this return is high because I faked that we got in at a lower price and we're sitting on $36 of unrealized gain on our long call that we bought at 50 because the current price is 86. Actually, let's put that in. I believe I saw the current price to be $86 if I bought it today. So let's use a current example. I buy the 320 call now for 86. And we sell that near term, March 380, which is close to at the money as you mentioned. Okay, 24% return. That's a good return for a 30-day trade looking at the first expiration cycle. Risk to the downside, if the stock falls 10, 20%, we might see a 30, 40% loss on our diagonal spread because leverage works both ways. We do have a capped gain and it pulls off. Okay. Yes, I'm going to go into this. An advanced concept, but I want to discuss it. The 320 call I bought and this is a good approach for diagonal spread traders that are trying to mimic stock ownership with this approach, that delta on the 320 is probably somewhere around 0.65 to 0.7, somewhere in that range. I might even go higher and look specifically for a 0.8 delta. This delta that I'm selling at 380 is probably around 0.5 to 0.45, somewhere in that range. Okay, so what does that mean? This means that I have a positive delta still, because as the stock moves up, I'm gaining 70 cents, which is also going to be increasing, and only losing 45 cents on the short. Now, on a covered call, you expect to see this, right? You expect that hockey stick graph to continue on. Why does this change and we see this going here? Because one important thing to note with the strategy is that on expiration, this short delta, the March option that I sold, has only one choice. It's going to a delta of 1 or it's going to a delta of 0. See, with my 380 strike, if the stock stays at 371, this delta is getting close to 0. Premium's getting close to nothing. But if it's at 385, 382, that delta is immediately going to 1. And this delta of my long option is still at 0.75. The delta ratio gets flipped as you get closer to this expiration if you're slightly in the money. So for every dollar the stock moves up, you're giving back more on the short call. You're paying intrinsic 1-to-1, and your long option is not yet at a delta of 1. That's why it tails off there. That's why it's different than a covered call. Why is that important? Because many investors that try this strategy after using covered calls do it incorrectly and get into a position that was too expensive, and they have an upper and lower break even, and they're thinking that the stock's going to continue this way, and they're going to have this percentage return if it's anywhere above their 380 strike, when actually they could be at a loss in the position. Okay, now, we see here we've got this good return. This was the 30-day out 380 call at 7.95, close to at the money, getting a good premium. 2% lowers this down to about $77 cost basis, $7,800 from $8,600 originally. I go further out of the money with that right cycle, 28 days out, so still about 30, 35 right cycles, but we go to that 410 for more room, which is maybe 1 standard deviation away at this time. You're still going to lower the cost basis, but of course, you have a higher gain potentially. What do I mean by that? That's referring to the high point, the trigger point if it goes up to 42.3%. The trigger point if it goes up to 410. That's basically the gain on the long call, nothing to do with the dollar premium received. And you only gave yourself a little bit of hedge from where we are right now. Right? Break even's at 363. Before it was down a lot lower. Okay? So based on what your approach is, and if I did this, well, let's think about it this way. The right cycles I talked about. Your long call is 700 days away. We're looking to sell options roughly 30 days away. So this gives me, what, 20, 22 right cycles roughly? Meaning if I sell every 30 days, I could sell premium 22 times. But if I'm going 1 standard deviation away, even 30 days out in time, and only collecting an average of $1.50, does 22 right cycles times $1.50 by itself, considering no appreciation, though hopefully you're in this is a bullish strategy, so hopefully you are expecting appreciation, but would this number pay for this by itself? The answer is no. It would not. Okay, so that's the balance. I know you want to be out of the money to be the 1 standard deviation, but you have to ask yourself, is the premium you're receiving worth it for your trading plan? And you won't be able to go likely 7, 10, 14 days out in time with those weekly or biweekly near-term calls, Gary, 1 standard deviation away and expect anything more than 0.5% of premium against the current stock price, which may be 1 or 2% against the leap. That's why you see many investors selling at the money in this case. Now, I wanted to bring up a point Sam mentioned. Sam said another thing to consider is that, another thing to consider is that maybe this isn't the approach right now with the market extended and seeing some of the warning signs. Maybe you should be more interested or looking to more protect the long calls or the gains in these 2-year out leaps that you have, rather than still speculating on bullish if the market continues to go down in the next 5 days or so. Worried about being at the top there in that case, and that this might not be the strategy to continue in that scenario. Yes, so 2 to 3 months out, that's where you likely want to look, Gary, to have to go to a 1 standard deviation, right? And that's what we kind of saw. And we could go, let's just take a quick look here before we get to some of our other comments here from O, I believe it is. Just the first initial there of O. Let's go 60 days out, 45 days out, middle range, yeah. April expiration standard, the 17th, 56 days out in time. 410, we're thinking that's 1 standard deviation, but compared to the 30-day, remember we were getting about 135 for the March 410. Going twice the amount of time, we don't get twice, we do actually in this case. That's kind of interesting. Usually you don't see that, but that's okay. So in this case at midpoint, that's maybe too wide, but we're looking at about 293, okay? And so yeah, it's a 43.6%, but remember that's here. Your cost at 86, and you collected 292. So not quite, excuse me, at the 3% or so that you might expect to see in that case for this scenario. Oh, I'm sorry, it is. It is. It's about 4% against the cost of that, but we're at, you know, to 0.5% of the underlying stock price at 371, no, 0.6. Anyway, so that still gives you a little bit better break even, increase the premium. That's very interesting, though. What I mean by very interesting is that the March series I thought I selected was 28 days out, and this is 56 days. It's almost an even, and sometimes you don't see that with the expirations. It's close, but it's exactly twice the amount of time. But with a premium of 135, this would have put me at 270 to double it, and this is at 293. Normally, you don't see that. And this is probably due to a wide bid-ask spread, a little bit too wide of a bid-ask spread here that I might not be able to get that midpoint. But usually, when you go 2 times the amount of time out in options with the same strike, or you go 3 times the amount of time, you're not collecting 2 times the premium. You're not collecting 3 times the premium. It's less. That's why it's always better to sell shorter term to get a better annualized return, in theory, right? If you were able to do it consistently, month by month by month, you get a better return than selling every 6 months out, even though the premium might be double or triple, but it's not going to be 6 times the premium of the current month. And that's why the weeklies are attractive, because the monthly option is not 4 times the cost of the weekly. It's less. So you get a better, in theory, annualized return selling week by week by week by week, but you're collecting lower premium up front as well. Okay? Let's see, Sam says, when your premium is too big, it's hard to recover the premium by shorting against the leap calls. Yeah, that's why the right cycles are important, what that term I used. And that's another thing that you want to consider here with that, if any of you are interested in looking deeper into the diagonal spread, ideas in the diagonal spread, the terms I'm mentioning here about right cycles and more. If you go to the free webinars page, it's always free, powerup.com/webinars.asp, go into the option strategies, scroll down through the list, and right about here, yep, calendar spread basics from March 1st, 2017, almost exactly 3 years ago. Why do I have a 3-year-old webinar in here on calendar spread basics and calendar spread criteria? Honestly, because if I was teaching these 2 webinars next week, back to back, it'd be 95% the same exact content that is in those webinars. Okay? The concepts are timeless. Maybe some changes to the Power Options tools happen for the imagery, but anyway, in the option strategy section, back to 2017, 3/1 and 3/15, 2017, calendar spread basics, defining horizontal versus diagonal, proper structure, specific terms, what to look out for, goals and expectations, and then criteria that we prefer to use for the types of stocks and the type of structure we want to use as well. Okay, so Gary, that's what I have for you in relation to that. If your goal is to stick with 1 standard deviation away, you're absolutely going to have to stay 30 to 60 days out in time. And The reason why you see so many sell at the money is because of that time value, because it is a game of time value, and you also have the highest time value at the money. Going back to our covered call discussion, Fernando offers up, I never roll up a call in the money. I accept the plan assignment or closing the call. Usually I rebuild the position later on. Usually I rebuild the position with a married put long or an extra call to keep a delta of 0.30, positive delta of 0.3 in the entire position. Okay. Yes. Oh, thank you, Fernando. Thank you. Am I still here? No. No. I hate to do this while we're here. I'm going to try to go backwards to get back to the screen. There's something very, very important I needed to show everyone. It's 90. That's perfect. Okay. The other concept you must consider, Gary, and this isn't the good example. Let's go back to that one. I'm going to go 2 weeks out. Domino's Pizza. We're going to sell the 380 call. An important aspect that is in that webinar I just pointed to. This is a 60. Oh, perfect. Perfect. Okay. I think that's going to give me the perfect example of what Fernando hinted at, what I always mention. Not quite perfect, but close. Okay. This is one that is nearing that double loss zone. Okay, and I'm going to get to you in just 1 second. I've got another question that came in. We're going to cover them all. It's only 5:30. Remember, as I said, we'll stay online as much as possible to make sure all questions are answered. And the good return of 21.8%. I want you to focus on this. What is this? This is my cost of my leap option, 86, minus the premium we received, 590, to take us down to 8,000. Well, my spread width is what? It's 60 points. Okay, this is one thing I never do. And I have the Power Options default search for diagonal spreads set up to avoid this. I'm looking at a 60-point spread with a debit of 80-10. I never enter a position where the net debit is greater than the difference in strike prices. And why is that? Because you're looking here, Gary, at a potential return of 21.8% on this diagonal spread. But if Domino's Pizza does what we expect and what you're fearing, I'm selling at the money here at the 380. You wanted to go on standard deviation out, which I think is great. But let's say I did this trade, 6th of March, 14 days shorter term, trying to maximize time value premium, and it gaps up to 390 Monday morning. Just because you're in a diagonal spread does not cancel the obligation of what you have on this sold call. Meaning that I still have an obligation to deliver 100 shares of Domino's Pizza at 380 to the call buyer or the market maker, and I can be assigned any time the stock is trading above 380. So what? I purchase a 320 call so I can avoid any risks of having to short the stock, borrow shares from my broker to be assigned early on shares I don't own. My broker would just exercise the 320 call to get out at 380, and I'm fine. No, you're not. Because this was structured improperly. If that happens and you were assigned, and you also have to pay attention to the ex-dividend date, because if the ex-dividend is a little bit in the money, ex-dividend is coming up, you could be closed out of the position prior to when you wanted, and they would exercise the long for you to deliver the short. Now, in this case, you see why I wouldn't do this spread and why it's dangerous. It moves up. I get assigned early at 380. Broker exercises at 320. Buy shares of stock for me at 320 to deliver my obligation at 380. I get $60 back, but I paid $8,010. I get $6,000 back. That leaves me here, loss of $2,000. Why is that not showing up on the chart? Because the chart is based on calculating the position at March expiration using the Black-Scholes pricing model of the long option at short-term expiration. It's not accounting for the fact that if you get assigned early, you're actually at a loss of $2,000. You have to know that based on the structure of the trade that you entered, of course, and the rights and obligations of the strategy that you're using. This is accurate. If the implied volatilities of these two options remain the same, this profit and loss chart is accurate. But you have to know as a diagonal spread trader that if you're assigned early and your broker exercises the long, you're not going to be here. You could potentially be at a loss or at a significant loss on the position because it wasn't structured properly. Always make sure, even when you're selling a call after the fact, Gary, against your cost basis, always make sure that that new net debit that you have is less than the difference in your strike prices to avoid seeing a loss unexpectedly in the case of early assignment, which you can't control. Okay? The other side of the market's going to control that, not you. You're still in that obligation to deliver shares of stock and be assigned any time when that short call goes in the money, which I understand you obviously know, Gary, because that's why you're going one standard deviation out to avoid this. So, but that's very important for those of you interested in diagonal spreads. And if you watch the webinars, you'll see me there. Fernando, thank you very much for reminding me to bring up the topic of early assignment and the risk of trading diagonal spreads where the net debit is greater than the difference to strike prices. We have a filter on the power options search for debit to difference to strike ratio, or debit of the calendar spread position divided by the difference in strikes. And our default criteria is blank to 1. It's always less than 1, so the strike difference is always greater than the net debit price, so you don't get caught in this loss area. And another comment, ex-dividend date is something to watch out for too. If your short call is slightly in the money, remember, because of ex-dividends coming up, just like with the covered call, traders, investors might want to exercise that long call to own shares of stock to take care of the dividend. Your broker may be exercising that for you to deliver the obligation. And so you're out of the position, and you might not have the return you expected, and you were looking to do at least 5 to 10 right cycles, and you got 2. So always be aware of that as well, where your strike price is on these calendar spread positions, calendar call spread positions, covered calls, as you're getting closer to the ex-dividend date.